I'm in a stock. I've protected the position and locked in my gains. I can increase that by selling near-term positions more at the money to take advantage of the premium of the at-the-money bell curve. And to do that, now we only have monthlies here, so let's go ahead and keep it simple. Let's go ahead and just sell. I don't want to sell the 60 because I'm not looking to close out of the position and be assigned. If I wanted to, I'd probably just sell to close the stock right now, take my 11.6% profit and move on. So I'm going to go ahead and sell, the 65 call. It's only going to bring in about $1. Let's just make it $1 even at midpoint. 95 bid, 110 ask. Let's just make it $1. And what does that do to the position? Now, I have a guaranteed profit of 4.8%, a little bit better than our 3.1%. Could stand to make 15% if our stock's trading right at 65 at March expiration, above the 11.6% liquidation value I have right now, above the 10.6% guaranteed profit I could have if I bought that deeper in the money 70 put for March expiration 28 days out. I could only increase that profit if the stock continued to move above 70 or I sold a 70 strike. And you can do that, of course, right on the position insurance tool as well. I didn't select the call month. We selected the put month out to August. I could select the call month to March, and it would show me other opportunities of that, selling the call against the put that I purchased, what we call income method number 1 in the blueprint, to compare the locked-in profit versus the max potential return if assigned on the trade. And personally, that 65-65 combination that came up that we just did manually in the profit and loss chart is the one I would likely choose anyway. Has the highest locked-in profit, which is good, but also has the second highest profit if assigned if the stock's trading right at our short call strike price at March expiration. So that's probably the target I look for. I want this. This is pretty good too, 4.4 versus 14.8. But why not get a little bit extra protection at 4.8% here, the 15.1% potential, because I'm still planning to stay in the stock, because I'm still planning on it moving up in price. But there's a fault here, isn't it? This is a married put structure after the fact to lock in profit using income method number 1, just selling the call against the position. But where's the dilemma? I have a stock that's moved up in price. I want to reward myself by locking in the gains by using the proper put structure for adverse markets going forward, or choppy markets going forward, or maybe an earnings event coming up in the next 2 to 3 weeks. We applied the 3 core principles to go with the August 65 put. I want to reward myself, generate some income in, some premium in by selling the call against the position. But I chose to stay in the stock because although I'm not expecting it to go up to 70, which is why I avoided the 70 strike, whether it was in March or whether it was further out of time, I think that's too deep in the money in this scenario. I think the 65 is the prime choice in my opinion. But I'm staying in the stock because I think there is potential that it could continue to move up in price. I don't want to cap my gain if MMYT continues to exceed my expectations and moves up to 70, 72, 73, 74, 75. Next 28 days, that might be unlikely, but I don't want to take that chance. How can I leave the upside open? Well, I can give up some of the premium I just rewarded myself with. I'm going to buy a higher strike call at the 70 strike. This by itself, selling a 65 call for about $1 and buying the 70 strike looks like for about 35 cents is what we might get at midpoint, is a bear call credit spread. We generate 65 cents of credit for a true risk of 435 between the 5-point strike prices. As long as the stock stayed below 65, both calls expire worthless, and we would keep the net credit. If the stock moves up above 65, we have a problem where we're obligated to deliver 100 shares of stock we don't own at that short call strike price, and our long call expires worthless. It moves up above this strike, well, we're at full loss on the position, that 435. However, in the context of owning the stock in the married put position, we don't create a bearish position. We create some income to increase our bulletproof status, not as much as just by selling the call. We go from 3.1% just from the put up to a 4.2% guaranteed profit to the downside, with an unlimited upside profit potential if the stock does continue to exceed our expectations. We get this little heartbeat here between the strike prices because, yes, there's still that bear call in play where I've sold a 65 strike and bought a 70. And if the stock's at 70, well, I may have to close this spread position out and take that 435 loss. But in order to do that, the stock would have had to have moved up 10 points. I own the stock, and I own a protective put option, and I sold a call, the bear call, but the upside is left open because even if the stock goes up to 78 or 79, even if I'm assigned my shares of stock at 65 and my put option is declining and going to zero, this long call now continues to gain. This is a great play before earnings, what I typically refer to as the hat trick for locking in gains. We had a stock that moved up in price. We want to lock in some of those gains properly, following the 3 core principles of really any trading, but also the radioactive trading and married put approach. We want to reward ourselves and get some income in. Hey, 200, 300, 400 shares, collect $100, take the family out for dinner tomorrow night. But I like this stock and I wanted to stay in it for a specific reason. In addition to rewarding myself and locking in some of that unrealized profit, guaranteed no matter what happens to the stock going forward, I want to leave the upside open. So I'm going to enter in that other long call at a higher strike price, still keep 60 to 70% of the premium I generated in, but leave the upside open. 1, 2, 3. Lock in the unrealized gains, reward ourselves for picking the right stock, leave our upside open, going forward into choppy markets, going forward into an unknown event, going forward into a known event with an unknown outcome, such as an earnings event or other report. But that's what I look for in the insurance tool and power options. Put in your stock symbol, put in your cost basis, leave it at first at all expirations, and leave the call side at none. And just take a look at what your locked-in profit could be with the different expirations. Hey, if I do have earnings just coming up, I've been in this position only for 15 days, 12 days, 20 days or so. I like this, but hey, I want to see a little bit more. I know earnings are coming up, say, in 5 or 10 days. Absolutely. I might just buy this put or the March 65 put cheaply, lock in 9 or 10%, go through the earnings in 10 or 15 days. Hey, if it goes up above the put strike price and I make more than that guaranteed profit, fantastic. If the stock stays stable and it doesn't do too much, hey, I'll liquidate the position, still take close to that unrealized 11.6% profit. It's going to be a little bit more maybe than this 10.4, this 9.2, or I could sell a call against it at that time to get some premium in as well. Or I could just stay in the trade at that point, maybe move the put out further, continue it as a married put position after the earnings. Or if the earnings completely collapse, the stock drops down 25%, is trading at back at my cost basis at 54, it's down to 50, it's down to $52 per share. I've still locked in most of the unrealized profit. I'll just get out of the position. My sentiment has changed. I've locked my profit. I've probably hit my target goals for the trade, and I'll take that profit and look to move into a new trade further down the road. So that's what we look for. That's how I approach having a stock that has unrealized gains. What can I do to lock in the profit? I'm going to go to Power Options. I can go to the Signature Tools tab and click on Insurance, or I can go to the Married Put tab and click on Insurance. I'm going to put in my stock symbol, put in my cost per share. I want to select all expirations at first just so I can view through the various shorter term and longer term positions. Based on my goals for the trade, my expectations moving forward, the current conditions, I may stay short term, but likely following the 3 core principles, I'm going to go out to whichever expiration is at least 150, 160, 180 days out in time. I'll evaluate which risk best suits my goals for the position and what I want to see and what I want to pay and expectations of where I think the stock's going to be trading. Take a look at how I can reward myself maybe with a shorter term call. Again, following those 3 core principles, selling shorter term to match that time decay or radioactive decay line, but buying farther out in time. See the different analysis that comes up there. Then I can simply say, okay, this one looks what I want. I'm locking in 4.8%. Not quite half of what I'd have right now, but I want to stay in the position for longer term gains. And I could make 15.1% beyond the 11.6% I have right now if market conditions match my expectations. Take a look at it graphically at the profit and loss chart. Hey, everything is great, but I did cap my upside gain a little bit. I could make 15.1% in this scenario, but if this stock continues to exceed my expectations, let me take a look at the next highest strike in that short-term expiration. Create the bear call credit spread, or what is called income method number 6 in the blueprint. One of these, I apologize, one of the 13 income methods that we use in the blueprint to lower risk, bulletproof the trades from a married put from the start or a married put that you started after locking in the gains. Now I've completed what I call the hat trick. We've locked in profit on the position, no risk, a bulletproof trade. Rewarded ourselves by generating premium for picking the right stock in the right direction, and at the same time went ahead, took some of that profit away, but not too much, to leave the upside open in case expectations are exceeded. By the way, the Fortinet position that I have open in my portfolio at RadioActive Trading, in the Fusion portfolio, you can track the married put positions for both Ernie and myself. It's not a bulletproof trade, but I do have an income method number 6 on this that I put on going into Fortinet's earnings about 10 days ago. The stock briefly went above the strike price. It was a different strike. It was the 70 and 75 on Fortinet. And the stock briefly went above 70. It was trading at 71, 70, 50. And today it pulled back a little bit and is below both strike prices. So did I do any arcane management? No. I let both calls expire worthless. I kept the credit. Come Tuesday of next week, since the markets are closed on Monday, I'll look to do a new income method on this position, one of the other riskless spread trades on my Fortinet married put trade, maybe income method number 5, ratio call spread, but used in the context of the married put. There's nothing naked in that position. It gives you a little bit more oomph than just selling the call on the trade as well. So that's how I look for locking in profit, unrealized profit on my stock positions.